Ladies and gentlemen, welcome to the Lending Club earnings call for Q3 of 2023. Now, full disclaimer, I don't own this company. I don't like this company, but they give a lot of great insights into the marketplace for selling loans, and particularly unsecured personal loans, while also trying to derive a bunch of deposits from clients leaving their money at the checking accounts. Okay, this is in very similar regard to SoFi stock, and in that case, I love this earnings call because it gives a lot of insights for a company that I do actually invest in and have money betting on. Wow, 1 minute late. This guy is crazy. I'm out of my mind. I'm out of my dang mind. I'm doing things. I've got things going on. Okay, I got things going on. Sometimes the boy looks away from the clock from time to time. I lose 60 seconds. Okay, lots of news today. It was a red day overall. Some bad payments news coming out from Worldline, and you know what? Got to take some notes for the FinTech Frenzy. I'm working for you guys here. Okay, Lending Club. As always, the total addressable market is looking extremely hot. I guess I got to back it up. The marketplace for loans is looking extremely hot. Always is, always has been. Maybe that will be a little bit better. New record high for outstanding loans from credit card debts. Okay, companies like SoFi benefit from this too, because obviously we want to debt consolidate that, but also we also offer credit cards at SoFi, so hopefully that we also take advantage of that as well on both sides of the equation. Over on the interest rate side is also quite exciting for both Lending Club and SoFi, and any sort of company that will try to debt consolidate these loans for a couple of reasons. As these interest rates are spiking up, that means that whenever you debt consolidate, you need, or the value proposition is that you're going to lower the overall interest rate. Okay. What's great about this raising interest rate, it sucks for the consumer. I apologize. I'm an investor here in this standpoint. So, is that maybe you want to get a 4-5%, decrease to debt consolidate. Hey, we'll bring this 15% down to 10%. Well, if it's up to 21%, okay, well, we'll bring that down to 16% for you. Kind of nice. It's still very beneficial for the consumer. And whenever you're talking about the side of SoFi, obviously that could also mean higher margins. It doesn't always mean that, because there will be things like more money to actually address the cost of capital, right? If Fed rates are going up, it also means that the cost for things like warehouse facilities and deposits also go up as well. And Lending Club is also seeing that. So a couple things. Lending Club had already come out saying that they were expecting around $1.4 to $1.5 billion of total originations, a little bit lower than their previous guidance. And they came within that boundary and a little bit on the high side, not of their original guidance, but of their new changed guidance. So that's completely fine. And actually, if I skip along here to their net income, they came in, they said it was going to be $4-5 million in this new preliminary earnings results, and they came in at the $5 million range. It makes them look half decent. Okay, whenever looking at the stock after hours, it is actually down still 0.2%. However, being up originally whenever the stats did come out. I'll tell you why I think they should be selling off, but this company continues to show worse and worse results every single quarter, not necessarily to a fault of their own. I mean, I would necessarily say that there are maybe some management decisions that could be changed within the company, but it's not 100% their fault. This is definitely a macro problem. As the macro starts to improve and there's an environment where selling loans actually becomes beneficial for them, this business will turn around. There's a real opportunity for that. But that being said, whenever we look at Q4 guidance for next year, this is where things maybe take a turn for the worse, right? They're expecting, total originations in the same sort of ballpark, maybe even a little bit higher than this quarter. However, pre-provision net revenue, meaning this is sort of their statistic for saying what is revenue minus cost of goods, right? They expect it near half of what it was this quarter. So 35 to 45 million, let's ballpark it at $40 million. And then let's see where it was this quarter, 72.8 million. Last year, near $20 million. This is not necessarily good, right? There is some problems here. And so, Lending Club definitely needs to address this, but they're kind of at the whim of the marketplace, considering that they continue to sell loans. And this is exactly why I want to be on this earnings call, why I want to hear from them on this earnings call, is that it's really important to know, what are the banks doing? What are you guys seeing in the marketplace? This will affect SoFi. We have to remember, unsecured personal loans, yes, I'm sure there are some differentiating factors between how much they could sell for, depending on the type of client and the geography of the client, these sorts of things that make lending a little particular per region. But for the most part, these are American citizens with high FICO scores, with high incomes. SoFi is a little bit higher than Lending Club, but still, Lending Club definitely leads towards the high side, 700 plus. And in that case, they are absolutely facing massive problems. Does that mean massive problems for SoFi? No, but it does mean that it makes executing on their marketplace and what they're going to do with their loans exceptionally harder, because they're in an exact same environment as a company that is deteriorating. Now, they're still making profits. This is not a dying company. I want to make sure that people understand this. Lending Club is not closer to bankruptcy, but it's not looking like they're going to be having great shareholder return anytime soon if you're not quite growing in this bad marketplace, which is hard, but that's where great management comes in. That's where, obviously Anthony Noto has absolutely shined in these days. Let me see what they're saying here. Securities available for sale at fair value. They're saying average yield now, balances has increased quite a bit, 437 to 602. Quite interesting. Going quarter over quarter from 5.44% to 6.3%. Okay, yields on securities increasing due to the senior security via the structured certificate program. Oh, I did actually, that actually reminded me. I wanted to show off deposits. By the way, some of these numbers did actually get better. Majority insured deposits did get a little bit better from quarter over quarter. They were at 85, went up to 86. A strong capital buffer went up from like 12.8 to 13.2. These are good things to see. I'd like to see what their cash was last year or even last quarter. I don't quite remember. I'll have to take a look at that. I'll do that whenever the earnings call is on. But the held for investment loan fair value went from 200 down to 170. Meh. Like I said, not a fan of this company. I don't like the brand. I don't like the company. I don't like the management. But they are in a business that I absolutely do like. Let me see a couple other things here. I remember seeing something on deposits while I was just reading through this really quickly. They had shown something on their deposits and the reason for their gains in deposits. I guess I could just search it. Low cost deposits. No, come on. Oh, you know what it is? I think it was on it was on their actual press release. Let me switch over to their press release and I'll give us a little extra insight. Total assets of 8.5 billion compared to 8.3 billion in the prior quarter. Deposits of 7 billion compared to 6.8 billion in the prior quarter, primarily due to an increase in customer certificate of deposit. So CDs are something that are absolutely growing in popularity because of the high rate of return that consumers can get. But one of the things that I find is so interesting is SoFi doesn't even offer these yet. A bunch of the banks that they compete with are absolutely seeing great benefits and saying there's primary growth in deposits due to a product that SoFi doesn't even have yet. Think about how that's going to affect, SoFi whenever they can actually offer those products. Why is Shopify falling off a cliff? Fintech is falling off a cliff because of what Worldline had to say. I don't think that, like Visa reported yesterday a great strength in the payments industry, and another payments company said, "Oh no, things are getting real bad." I don't know. Could be their internal execution. And one of the greatest things that I've seen with stop having to look at just the sector and start looking at individual execution is very much the importance of the conversation between Lending Club and SoFi. They're in the exact same category, and one is excelling and one is not doing great. And the one that's excelling is still facing absolute pressures on gain on sale margins and these sorts of things. But they are selling, their loans still at above fair value, and they're still seeing a bunch of things that, Lending Club might not be able to see, right? I haven't looked deeply enough to see that, but we'll have to wait to see how SoFi does. I think there's going to be more separation between what Lending Club has done and what SoFi has done. Other way around. I got to switch those hands. This is SoFi. This will be Lending Club. A tangible book value per common share of $10.21 compared to $10.26 in the prior quarter. Book value of 1102 to 1109. Tangible obviously being much more valued because it's real. Strong capital position with consolidated tier 1 leverage ratio of 13.2%, and common equity tier 1 or CET1 capital ratio of 16.9%. I hope SoFi continues to increase their CET1 ratio. They had quite a big increase quarter over quarter last year, but loan originations of 1.5 billion to 2 billion. Let me just make sure I switch over to the call here. There we go. As long as I got a little sound going, what I'll do, and it's going to get a little sexy quiet for a second, and I apologize, but I'm going to turn off the music, and we're just going to wait a little patiently for the earnings call as it's coming in within the next minute or so. Loan originations of 1.5 billion compared to 2 billion in prior quarter as a result of reduced purchases by bank loan investors, right? That's the marketplace that people are talking about. It's definitely still very slow. They brought in total net revenue of 200 compared to 230 of prior quarter. Marketplace revenue was 61 million compared to 83 million in the prior quarter, primarily reflecting lower pricing on sold marketplace volumes, partially offset by a one-time benefit related to a recouping volume-based purchase incentives from bank investor channel. Net interest income of 137 million compared to 147 million in prior quarter, reflecting a lower balance of held for investment loans, higher deposit funding costs. That's another thing too, that the higher deposit funding costs, I really want to see how much SoFi has been paying for their warehouse deposits this quarter, because it's been quite strong quarter over quarter bump. So hopefully that doesn't, it will continue. It will continue to go up because interest rates are going up, but I would like to see it not just absolutely skyrocket. Yeah. It's been a pretty substantial just deterioration of this company in the last little bit. And like I said, not much of it is a fault of their own. It's because these banks are just pouring so many loans onto the market right now that it's just bringing down the whole market. It's like if real estate had everyone puts their house up for sale, well, then it's a buyer's market. You get things for pretty cheap compared to fair value. The efficacy ratio actually did get a little bit better. 63.7% from 65% of last quarter, as high as 68.5%. But really, you still want to get that closer to probably 50%. Yeah, this is one of the things, SoFi actually does theirs very similarly here, where the majority is held for sale versus held for investment. But whenever SoFi does it, they don't quite mean it. They'll hold everything for sale and then sell a tiny portion of it, like less than 2%. when Lending Club says they're going to sell some loans, they're going to sell some loans. So, yeah. Oh, we got call. Let me switch over. And I got the presentation going as well while it happens.
Momentarily.
Oh, did I get duped? All right. Well, I'll mute that for a second because they just said momentarily and then put the music back on. Lending Club did not move at all, right? Let me double check that for you. Yeah, 0.2% on the downside, not really a strong movement. They did go up a little bit once people saw that they were on the higher end of their guidance. And then I think that once they saw Q4 guidance, they're like, oh man, the trouble's not over. Oh, actually, it just did a spike down 1.3% now in the after hours. And this music's coming in strong. I'm glad you guys don't have to hear this. Bear with me. Oh,
Thank you for attending today's Lending Club third quarter 2023 earnings conference call.
do we have volume? You guys hear that?
My name is Sierra, and I will be your moderator today. All lines will be muted during the presentation portion of the call, with an opportunity for questions and answers at the end. If you would like to ask a question, press star 1 on your telephone keypad. I would now like to pass the conference over to our host, Artem Nelevaco, Vice President of Finance.
Thank you and good afternoon. Welcome to Lending Club's third quarter earnings conference call. Joining me today to talk about our results are Scott Sanborn, CEO, and Drew LaBenne, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. On the call, in addition to questions from analysts, we will also be answering some of the questions that were submitted for consideration via email. Our remarks today will include forward-looking statements, including with respect to our competitive advantages and strategy, macroeconomic conditions and outlook, platform volume, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and presentation. Any forward-looking statements that we make on this call are based on current expectations and assumptions, and we undertake no obligation to update these statements as a result of new information or future events. Our remarks also include non-GAAP measures relating to our performance, including tangible book value per common share and pre-provision net revenue. You can find more information on our use of non-GAAP measures and a reconciliation to the most directly comparable GAAP measures in today's earnings release and presentation. And now, I'd like to turn the call over to Scott.
All right, thanks, Artem. Welcome, everyone. We delivered another profitable quarter, thanks to disciplined execution and proactive efforts to appropriately position the company in what remains a dynamic environment. Our $1.5 billion in originations was in line with our expectations. Total revenue for the quarter was $201 million, and pre-provision net revenue, which is revenue less non-provision expenses, was $73 million, which was well above the high end of our guidance and aided by a couple of non-recurring items, which Drew will explain. The quarter's results were further supported by our ongoing expense management efforts and our difficult recent decision to align staffing to current market conditions should position us to stay resilient going forward. I want to begin by providing context on the current operating environment, which remains challenging, particularly on the investor side of our marketplace. Following the banking turmoil that emerged earlier this year, bank investors, which historically comprise 50% of our marketplace, have temporarily moved to the sidelines as they focus on fortifying capital and liquidity levels. While we continue to have productive discussions and the appeal of our high-yield, short-duration assets is clearer now more than ever, banks are currently focused on right-sizing their balance sheets, and their capacity to invest is likely to remain restricted in the near term. In anticipation of this shift in marketplace dynamics, we have been leaning into our bank capability to build unique new structures to better serve asset managers and LendingClub in today's environment. In Q2, we launched our structured certificates program, which is essentially a two-tier private securitization in which LendingClub retains the senior note and sells the residual certificate on a pool of loans to a marketplace buyer at a predetermined price. This effectively provides low friction, low cost financing for the buyer. And in exchange, LendingClub earns an attractive yield with remote credit risk and without upfront CECL provisioning. As a bank, this is something we are uniquely positioned to deliver for marketplace investors. Interest in the program is strong and growing, which is a testament to the strength of our credit, given we're selling residuals in a market where residual sales are few and far between. We more than doubled the program in Q3 from Q2 and expect to roughly double it again to as much as $1 billion in Q4. In total, we now have close to $2 billion of signed orders for over the next 6 months. Not only are structured certificates helping us to attract new investors, they're also helping us make efficient use of capital and reposition the balance sheet to capture low-risk interest income off of the senior note. Another advantage of our bank is our ability to hold and season loans for investors, earning interest income for LendingClub while increasing the certainty around future credit performance for the buyer, which is especially important in this environment. We're receiving interest from investors in the program and originated $250 million in Q3 to replenish the $200 million in loans sold earlier in the quarter. Now let's turn to credit. We remain focused on prime originations, with near prime representing an immaterial portion of our total Q3 issuance and of our retained portfolio. We've adapted our underwriting standards to the inflationary environment, which has resulted in consistent credit performance on newer vintages. Inflationary pressures are visible in vintages originated before we began tightening, and we therefore increased our provision based on observed trends and our outlook. I'd note that return on equity on all vintages remains north of 20%. Our expected lifetime losses remain within the range we previously communicated and better than our competitive set based on available industry data. Looking forward, a historic refinance opportunity awaits us. Credit card balances have grown to $1.3 trillion, and average credit card interest rates are now above 21%. Thanks to foundational investments we've made over the past several years, along with our proven ability to scale quickly, we are well positioned to meet massive consumer demand as conditions normalize. We've been making steady progress on key initiatives that will provide powerful, differentiated solutions and enhance our value proposition to both new and existing members. Before the end of this year, we will have accomplished the following: included loan servicing into our banking mobile app to provide a seamless member experience across lending, spending, and savings. That's harder than it sounds. In fact, many banks have instead opted to create multiple apps serving specific product verticals. With our mobile-first multi-product platform in place, we will have a single powerful engagement vehicle for offering new solutions to our members. We'll also be testing the first generation of a line of credit product that allows approved members to easily sweep accumulated credit card balances into fully amortizing payment plans. This paves the way for a revolving line of credit product in future years and builds on the proven performance we've seen from repeat members. And we will launch the first phase of a comprehensive debt monitoring and management experience. While in early development, this will ultimately give members a way to track, prioritize, and optimize debt payments, especially credit card payments, which will be of significant value to LendingClub members. Taken together, these innovations will further drive member engagement and satisfaction, which in turn should translate to better credit outcomes and a higher lifetime value. Our business is evolving, and we're changing our focus from building a strong mobile banking foundation to focusing on multi-product member engagement. To lead that effort, I'm happy to announce that we've hired Mark Elliott as Chief Customer Officer. With experience at JPMorgan Chase and Cap One, where he led digital banking efforts, Mark brings a unique background in strategy, marketing, and customer focus, especially in retail banking, as well as a proven ability to coordinate these areas to fuel growth. I'm looking forward to his leadership as we march forward. I want to close by thanking LendingClub's employees for their continued dedication through what has been a trying few quarters. Lending clubbers are demonstrating their resilience, and I have no doubt they'll be ready, willing, and able to accelerate when the opportunity presents itself. With that, I'll turn it over to Drew.
Thanks, Scott, and hello, everyone. Let me walk you through the details of our results in the third quarter, starting with originations. Originations were $1.5 billion compared to $2 billion in the prior quarter and $3.5 billion in the third quarter of 2022. Of the $1.5 billion in originations, approximately $500 million were whole loans for the marketplace, which were primarily sold to asset managers. $450 million were originated for the structured certificates program, which is showing strong demand, as Scott mentioned. We also accumulated approximately $250 million in held for sale for our extended seasoning program to meet future investor demand for seasoned loans, and we retained over $300 million in our held for investment portfolio. Now let's move on to pre-provision net revenue, or PPNR. PPNR was $73 million for the quarter, compared to $81 million in the prior quarter, and $119 million in the third quarter of 2022. PPNR in the third quarter included severance charges and the benefit of two non-recurring items. First, a $10 million revenue benefit related to customer forfeitures of purchase incentives from the bank investor channel. Importantly, this was a one-time benefit, which will not recur in the fourth quarter. And second, approximately $9 million from lower accrued variable compensation. This was also a one-time expense benefit, which is not expected to repeat in the fourth quarter. PPNR also included severance charges of $5.4 million, partially offset by a $4 million reversal of previously accrued compensation for those individuals. Now let's turn to the first component of PPNR, which is revenue. You can find revenue detail on page 9 of our earnings presentation. Total revenue for the quarter was $201 million, compared to $232 million in the prior quarter and $305 million in the same quarter of the prior year. Let's dig into the two components of our revenue. First, non-interest income was $64 million in the quarter, compared to $86 million in the prior quarter and $181 million in the same quarter of the prior year. As we indicated last quarter, the sequential change in non-interest income was primarily due to two items. First, lower fee and gain on sale revenue driven by the change in marketplace volume. And second, lower price on loan sales due to a lower percentage of purchases coming from banks. You can see this impact in the fair value adjustments line. These items were partially offset by a non-recurring $10 million revenue benefit from the forfeiture of purchase incentives that I mentioned earlier. On to net interest income, which was $137 million in the quarter, compared to $147 million in the prior quarter and $124 million in the same quarter of the prior year. The change in net interest income was primarily driven by lower average loans held for investment. This was partially offset by an increase in loans held for sale and securities from the structured certificates. These securities generate a high risk-adjusted return, and we expect the balances to further increase in the fourth quarter. Net interest income also benefited from $1.3 million in revenue as a result of a hedging program implemented early in the third quarter to help partially mitigate the impact of further Fed rate increases. On the next page, you can see that our net interest margin was 6.9% compared to 7.1% in the prior quarter and 8.3% in the prior year. This change reflects the combination of our growth in high-yielding risk remote securities from the structured certificates program, as well as higher funding costs in the period. Now please turn to page 11 of our earnings presentation, where I'll talk about the second component of PPNR, non-interest expense. Non-interest expense of $128 million in the quarter compared favorably to $151 million in the prior quarter and $186 million in the same quarter last year. The sequential reduction was primarily due to three items. First, lower accrued variable compensation that I mentioned earlier. Second, lower variable marketing expense compared to the prior quarter due to fewer originations. And third, continued cost discipline across the company on non-compensation expenses. As Scott mentioned, we made the difficult decision to reduce headcount to reflect the continued macroeconomic challenges. This was a necessary step to align our expense base to the current market conditions as we head into 2024. This will result in approximately $6.7 million of severance-related charges, $5.4 million of which were incurred in the third quarter, with the remainder coming in the fourth quarter. We expect to realize an annualized compensation benefit of $30 to $35 million when compared to the second quarter of 2023. Given all the moves in expenses, we are providing a range for non-interest expense, excluding marketing expense, in the fourth quarter of $115 to $120 million. Next, let's turn to provision. Provision for credit losses was $64 million for the quarter, compared to $67 million in the prior quarter and $83 million in the third quarter of 2022. The sequential decrease was primarily the result of lower day one CECL due to fewer loans retained into held for investment in the quarter, partially offset by an increase in loss reserves, primarily for the 2021 and 2022 vintages. As you will see on page 13 of our earnings presentation, we have incorporated this increase in reserves and updated our estimates for the expected net lifetime loss rate on the 2021 and 2022 vintages. The estimates of 8.1% and 8.8% respectively are within the ranges we provided last quarter and include both quantitative and qualitative reserves. While it's still early to judge the ultimate performance of the 2023 vintage, our initial observations are that it is showing stable performance, benefiting from the tightened underwriting we've implemented over the last several quarters, and we continue to expect ROEs in the 25 to 30% range. As Scott mentioned, our current ROE projections for all annual held for investment vintages are north of 20%. Now let's move to taxes. Taxes in the third quarter were $3.3 million, or 40% of pre-tax income. As I've mentioned before, we will have some variability in the effective rate from quarter to quarter, primarily due to variation in the stock price between the vesting date and the grant date of restricted stock units. Year to date, our effective tax rate is 29%, roughly in line with our long-term expectation of 27%. Now let me touch on the balance sheet. Total assets were up modestly to $8.5 billion compared to $8.3 billion at the end of the previous quarter. This is the first quarter where we've had a meaningful shift to more securities from our structured certificates and a modest decrease in our held for investment loan portfolio, which ultimately should lead to strong risk-adjusted returns given the efficient use of capital. More specifically, structured certificates increased by approximately $300 million, reflecting the growth in the program. As you'll see on page 15 of our earnings presentation, over a third of consumer volume production held on balance sheet in the quarter was via the structured certificate program. And we expect that to increase to 60 to 70% in the fourth quarter. Loans held for sale at fair value were $363 million at the end of the quarter, as we sold approximately $200 million in seasoned loans during the quarter and held an additional $250 million of originations as we begin growing a seasoned portfolio for future sales. Our consolidated capital levels remain strong, with 13.2% Tier 1 leverage and 16.9% CET1 capital ratios. Our available liquidity remains healthy, with $1.3 billion of cash on hand, and 86% of our deposits are insured. Additionally, we continue to maintain substantial amounts of unused borrowing capacity at both the Federal Home Loan Bank and the Federal Reserve Bank, with a total of approximately $3.8 billion of available capacity at September 30th. Now let's move on to guidance for the fourth quarter. Given the interest in the certificate program, we're anticipating a modest increase in originations with a range of $1.5 to $1.7 billion. This volume increase will largely offset incremental pressure on pricing, as Q4 will represent the first full quarter without meaningful bank investor participation. The marginal economics of marketplace loan sales are nearing break even, and therefore our go-forward earnings should be less sensitive to changes in marketplace volume. We expect PPNR to range from $35 to $45 million. We plan to have positive net income for the quarter. While we are not providing 2024 guidance at this time, we do expect current conditions to persist into the first half of 2024, with volume and pricing at similar levels to our Q4 outlook. So, as we are exiting the year, we have taken steps to position the company to operate in a difficult environment, including leveraging our bank capabilities by growing and remixing the balance sheet to more structured certificate securities, improving resiliency, including the cost actions we have taken throughout the year. As a result, we plan to remain profitable and preserve shareholder capital while investing in new capabilities to maintain our readiness for growth when conditions permit. With that, we'll open it up for Q&A.
If you would
Really,
like to ask
really
a
happy with this
question,
so far.
please press star followed by 1 on your telephone keypad. To remove your question, press star followed by 2. And if you are using a speakerphone today, please pick up your handset before asking your question.
It's just good
Our
insights
first
for
question today
SoFi
comes
so
from
far.
Bill Ryan with Seaport Research Partners. Please proceed.
Good afternoon. Thanks for taking my questions. First one is sort of credit related in the provision. And I was wondering if you could, maybe quantify what the dollar amount of the additional true up was for the held for investment portfolio, and what gives you confidence that you've, based on your analysis, that you've got it covered, at least based on what you know now about the macro environment.
Yeah, hey Bill, it's Drew. Thanks for the question.
Mm-hmm.
Of the additional provision that we took on the back book, that was about $20 million between the two vintages that we put on. And obviously under CECL, when we're redoing our provision estimates, we're taking the new expected discounted lifetime losses into the provision all at once. So the estimate that we're putting forth here at Q3 is our best estimate at this time, and we'll continue to watch it. But I'd say just in the grand scheme of kind of how the provision has moved on that back book, I think we're up 7% at this point. So while taking it all up front creates a little bit of a larger provision, this isn't I wouldn't call it a massive move in the expected performance of the portfolio.
Yeah, and Bill, hey, one other thing to add, and just kind of understanding the dynamics is that at least when you kind of look at the 21 book, it's really been, the initial outperformance was really strong, right? That post-COVID outperformance. So if you look at kind of lifetime losses within that, there was a period of outperformance where we actually released a provision, and I know you've probably heard others in the industry talking about, those charge-offs didn't go away; they just got deferred, and that's kind of what you're seeing. So we basically released it and are now taking it back. It's not actually a meaningful move off of what we thought day one. It was just we thought it got better, and then it came back to what we had initially thought.
Okay, and one just follow up on the volume side of the equation. So question's been kind of coming up. I mean, obviously you dialed back in your volume. You talked about the bank investors, which have historically been 50%, buying 50% of the originations. That's kind of gone. But there's also a question about, competition. I mean, is irrational pricing by some competitors, maybe, different channels of marketing? Is there anything else going on in the volume, or is it mostly just related, or pretty much just mostly related to the bank buyers withdrawing from the market?
Yeah. The dominant piece is really, it's not on the borrower side of the house. The dominant piece is really investor supply of capital. You look at the competitive space, a couple nuances maybe worth talking about is, competition in the lower FICO bands has definitely lessened. Right, there's just not a lot of investor appetite for that particular profile at the moment, and so a lot of people have pulled back. But competition in the higher FICO, that pretty much most people have shifted there. We have always been a very effective competitor with, the highly optimized processes we have and the data advantages we have. You can see our marketing remains amongst the most efficient in the space. So it's really, competition isn't driving it. And in terms of who we're competing with, I guess if you looked at three categories, kind of those with bank charters that are either direct banks or new bank charters, They're obviously still competing. I'd say fintechs that raised significant capital within the last 2 years are still competing. And then, fintechs that haven't raised capital in the last 2 years, I'd say are less visible in this environment.
Okay, thanks for taking my questions.
Our next question comes from David Chiaverini with Wedbush Securities. Please proceed.
Hi, thanks. Wanted to ask about the volume of loans sold through the marketplace. The net fair value adjustments, that negative $41 million in the quarter. I was curious, at what % of par are loans or were loans sold at in the third quarter?
So our average sales price was low 96s in terms of where we sold. So just about a 4-point discount, a little less.
And I think if I heard you right during the prepared comments, looking out to the fourth quarter, did you allude to that being closer to par, or how should we think about the fair value adjustments looking forward?
No, I think it's going to remain pretty consistent. Probably there should be a little bit of a drop as we go into Q4, but 96 is about where we view near break even on the sales. So going any lower than that, much lower, going lower than that would not really make sense to us from an issuance standpoint.
Yep, got it. Okay, and then follow up on the credit quality side. So the net charge-off rate 5.1% in the quarter, with the portfolio kind of stable here over the past 4 quarters, around $5 billion, call it. Should we think of this as being kind of around the stable kind of going forward in this 5% range on net charge-offs?
No, we'll continue to move upward if we don't grow the HFI portfolio. So the charge-off rate you're looking at is just the held for investment portfolio, which, as we're doing more extended seasoning and more sales through the SLIC program, we'll also have less HFI coming on, which means the average age of that book is going to increase. So we'll see a slowdown effect, and charge-offs should continue to still move upwards, probably till the first half of 24, I would say. Now, keep in mind, this is under CECL. We've taken the reserves on a discounted basis for all these estimated charge-offs that are coming through.
And if we assume a kind of lifetime loss assumption in the high eights, let's use 2022 as an example, 8.8%, and we assume a 1.5-year average life, that would equate to 5.9% net charge-off rate. Is that the way to kind of think about roughly the upper end of where this could trend over the next several quarters?
Yeah, I mean the math isn't quite as simple as that. If you took because it depends on the speed of payoff of the balances, and the weighted average life isn't exactly 1.5. But for example, if you look at the 23 vintage and what we're putting on there, we're at 4 to 5% ANCL is our estimate right now in terms of where that's coming on. The ANCL on the 2022 vintage is lower. We haven't given the range, but it's lower than what you're citing there. And the main difference in the calc is at the very beginning of the loan, you have a 6-month period, so we're taking very few charge-offs at high balances. So it pulls down the overall ANCL over the life.
Yeah, just a thing to think about is the prepayment speeds over the last couple of years have changed pretty dramatically. So the duration on the 21 vintage is actually fairly short because consumers had enough excess liquidity that they were paying down faster, and that's really normalized up through till today.
Got it. Thanks for that. And then last one for me. Appreciate the guide on expenses ex marketing, the 115 to 120. Kind of zooming in on the marketing expense, most recent quarter, $20 million. Is it fair to assume the new origination guidance, if we're at the top end of that guidance range, then we could be north of $20 million, and then if we're at the low end of that guidance range, it could be roughly the same as $20 million. Any commentary on the marketing expense going forward?
Yeah, I think you're thinking about it right. Assuming the same marketing efficiency, which is a good assumption, that math should hold.
Yeah, that'll hold until, once we really get back in growth mode. We've obviously optimized right now for the lowest cost channels. Yet we are also maintaining our historical balance of new customers versus repeat members, right? So we're still investing in building the membership base today. So when we get back into growth mode and we go into higher cost channels, there'll be some upward movement on that, but we won't do that. I just want to come back on your question on pricing. I think there's a little maybe tick down in pricing in Q4, but as Drew said in his prepared remarks, we're really pleased with the amount of demand we're seeing for the programs we're offering. Our goal right now from here is to optimize price. We don't see a lot of pressure on price because we're not really going to sell below what we're selling at today. So where that would show up is volume or not, and for us to be doing more volume, we're going to meaningfully more volume. We're going to look for better pricing.
Great. Thanks very much.
Our next question comes from John Hecht with Jefferies. Please proceed.
Hey guys, thanks very much. Just a couple questions on the structured certificate program. I think you've given us sort of a mix into the near term. How do we think about the use of that relative to other, call it, liquidating outlets over the course of 24 if rates are where they are versus if rates drop? And then what does kind of the NIM trajectory look like thinking about those different scenarios?
Yeah, so I think for 24, it's a little early, I think, to call the ball on how much we're going to allocate to this program. Our initial goal when we set it up was to get multiple buyers in, get demand up for the program, which I think we have now accomplished, and then start to work on price. As we go into 24 and we think about how we're going to allocate capital and how we're going to allocate balance sheet, it will be a function of obviously demand, but also price that we're getting through the various structures, and we'll seek to optimize based on price and return on capital as we go through there. So I think we need more visibility into 24 before we're making that final allocation, but we'll look to come back on the next call with more details. As far as NIM, obviously the structured certificates, given that they're pretty risk remote in terms of taking a loss, they come with a thinner coupon, which is going to bring NIM down. But they also come with no provision. So we're making a trade here where we're going to have we're going to have some pressure on NIM, but we should have lower provision over time as well.
Okay.
And just as a reminder, I think it's probably clear from the presentation, but we have a 20% risk weighting on those securities right now. So as we're going into next year and we're thinking about our capital levels, that potentially gives us some more latitude to think about where our target should be from a leverage and a risk-based capital ratio.
Yep. And then on that topic, you guys mentioned 20%, whatever risk-adjusted weighting for the structured certificate program. Is that what we should think about what it would be when it, in terms of the regulatory capital ratios, or is that something that can change over time?
That is, as we are booking these A notes, these securities, they are coming with the 20% risk weighting as far as for example, our CET1 capital. There are certainly situations where if credit significantly deteriorated, that could go to a 50% risk weighting, or I guess 100% risk weighting. But assuming our credit outlook holds, then they're very efficient from that perspective.
Okay. And then last question, just kind of on the front end of the funnel. You guys cite, a big kind of pool of unsecured debt at fairly high rates of interest, so a growing TAM for you. I'm just wondering, kind of in the application side, what in terms of like the characteristics of applications for loans and kind of the funnel approval rates and this and that, is there anything you can point to in terms of trend changes or characteristics that are developing?
Yeah, I'd say mostly coming from us, consumer demand remains intact, right? They're continuing to see their credit card balances move up, and they're seeing the size of their bill move up in proportion to that, plus their rate. So on the demand side, it remains strong. We have moved even more of our origination to that use case and away from, other alternative use cases that would just result in providing people more cash, given that we're anticipating the potential for continued strain and or stress due to the inflationary environment. We are overall, we are tighter overall on the front end in terms of who we're allowing in. That said, some of the things I touched on is the experience we're working on and plan to have ready for when we resume growth will be the ability to get approved for a personal loan at the same time as you're approved for, a bank account, have the ability to service your loan in a mobile app, and within that mobile app, also be able to manage your credit card debt. One of the things that's really different about credit card debt is, unlike most of your car, your mortgage, all the rest, those are fixed payments. Your credit card debt varies in amount every month, both based on the balance and the rate, but also based on whether you pay the minimum payment or you pay it off or something in between. So consumers really don't have a very good way to see all of that data and manage it holistically. So we are working on an experience that'll help them do that, as well as a line of credit product that, as we're seeing those balances build, will be able to allow them to kind of sweep that automatically into an installment payoff plan. So, those will all be kind of in the background in development and optimization right now until the time is right. But we plan to be in a position to leverage all of that to, with what we think will be a pretty powerful competitive moat when the time is right.
Great. Appreciate the color, guys. Thanks.
Our next question comes from Reggie Smith with JP Morgan. Please proceed.
Hey, good evening. Thanks for taking the question. I guess I wanted to clarify a comment that you just made. Did you suggest that you had kind of pivoted your underwriting towards people that were refinancing credit card debt as opposed to using the proceeds for something else?
Well, it's always been our kind of largest use case. It's always been our dominant use case because on average, we're able to offer people, let's say, a price that's 400 to 500 basis points below their card. And, it's a big market, right? Half of all U.S. consumers are carrying credit card debt. And so we're able to know who they are, know that we can approve them and reach out and say, we got a better deal for you. But there are other use cases, especially for repeat members. Once they see how easy it is to work with Lending Club, and they're in our system, they can come back and use it for a whole variety of other things, home improvement, you name it, weddings, moving. So those latter alternative use cases, they're still in the mix, but they're a smaller percentage of what they would have been 2 years ago. We're not talking about significant shifts. We're talking about on the margin, but yeah, that is how we have one of the many ways we've adapted. We've also, tightened up our approval rates for people with federal student loans over a year and a half ago. There's a number of ways we've adapted to this environment. That's just one.
Good. Can you talk a little bit about your average APR on new originations this period, maybe contextualize it compared to last period, maybe a year ago?
Yeah, so in the prime space where we're originating, I mean, the coupons range anywhere from 10% to 18, 19%. But on average, we're skewing towards the higher end of that population. So they're going to be in the low teens in terms of the coupons that we're putting on the books for ourselves.
And in terms of coupon we've passed on, we're roughly in the near prime space. We've pretty much passed on all of the rate increases to that borrower. As we mentioned, where there's less competition in the prime space, we're probably closer to just under 300 of the, call it 500 rough rate increase.
Got it. And I think you guys talked about a sale price on loans at the 96 cent range during your prepared remarks, or maybe it was a question earlier. I guess, is there a way to kind of contextualize what the required return your buyers are looking for, either gross or net, today maybe versus a year ago, or how was kind of frame that difference there?
Yeah, I mean, I'd say, prior to the rate increase, right, on the prime credit, you were looking at an unlevered return of, call it, 4 to 5% for prime, and call it 7 to 8 for near prime. I'd say, those numbers today are more like 8 to 10 for prime and north of that for near prime. So, the way you get there is higher coupons, lower losses, and a discount. And, and I guess the other thing to note is, coming into this rate environment, we were selling loans at or above par. I think we were at 101. Pretty big difference in pricing given the pressure on returns. Now that part of that return equation is due to the loss of the banks, right? And because the banks on prime can absorb a lower return, but without them in the mix, with asset managers that are often warehouse funded, they need that higher return. And Reggie, it's one of the things you said is that if we look in the space at who we're competing with, I don't know that the economics that are being offered out there are sustainable for a lot of the businesses, right? The fact that we're able to do this unique structure where we can take the A note and capture some yield while also giving efficient financing, I think is pretty differentiated. And if this environment grinds on, I think it's going to be pretty important as a differentiator for our ability to continue to maintain profitability and marketplace.
I got one more question, kind of a two-parter on that structured note security. Just can you remind us the buyers of that equity tranche or residual tranche? Are those new partners, or are they existing partners that kind of moved over? You feel like existing asset managers have moved over to this structure. And then the second part of that question is there an opportunity to possibly move further down the credit spectrum, maybe enhance the yields there, given the support, or would that breach anything related to it being, something that's able to be non-CECL, non-reserved? Thanks.
Yeah, in terms of the partners, it's a combination. We had some investors that were sidelined due to the cost of the warehouse lines that we've brought back. But we've also added several new partners to the platform. So sort of the bigger names in private credit, have come onto some of the key names have come onto the platform. And as we mentioned, what we like is these are players that have got significant capital to deploy, and they are looking for kind of visibility into longer term flow. So we've got agreements now that extend out through Q1. Obviously, returns have got to keep coming in, and we won't call that committed capital, but the fact that we've got people who've signed up to make purchases up to $2 billion over the next 6 to 8 months, we think is a real strength. In terms of moving further down the spectrum, we certainly think that was the area that we had really tightened the most and the longest to go, and we're certainly seeing solid returns from that segment. So we do think over time, as more of that data comes in to show what we're able to deliver, there'll be an opportunity for us to potentially grow that marginally. But right now, investor appetite is lower, and it's not out of the question that it could go into a structure like the structured certificate program. Drew, anything to add?
Yeah, it would clearly, though, have a different structure, right? The advance rate would be much lower on something that has a higher credit loss content than what we've been doing now. But yeah, we're definitely able to offer that structure. We could probably even sell some of our seasoned loans through that structure eventually if we wanted to. So We haven't done that yet, but certainly possible.
That was actually another question I had for you guys, but it's good to know that that's an option as well. Okay. Thanks a lot.
Our next question comes from Tim Switzer with KBW. Please proceed.
Hey, I'm on for Mike Pereira. Thanks for taking my question.
Hey.
I was
Hi there.
hoping you guys could expand on. Hey there. I was hoping you guys could expand on the comments you guys made earlier in the near the beginning of the question session, where you mentioned about, there's more competition in the higher side of credit quality, higher FICO space among the personal lending market. And, can you help quantify maybe how many, competitors who have stepped up from lower FICO to higher FICO and kind of crept into your space a little bit, and maybe how that's impacted your market share specifically? I don't know if you have any numbers behind that, but just curious.
No, I mean, I guess the number of offers that are visible to customers has certainly come down. If you look at a key place like some of the aggregators, like a Lending Tree or a Credit Karma, so the number of people participating has come down. It's more pronounced in the lower FICO than in the high FICO. And, in terms of share, the best source of data for that will be TU, which comes out on a big lag. I'll tell you, we're not, long term, we've consistently been a leader in the space. In this particular market, that is not a metric that we're managing to. We're most focused on delivering a predictable return for ourselves and our buyers. But what I would expect to see is that, certainly some of the banks that are playing in prime, that are direct banks, right, that are their business model is to be adding the assets to the balance sheet, are going to continue to operate.
Okay. And about your guys' comments about the first half of 24 probably looking similar to Q4, does that mean we should probably assume a similar outlook on expenses, or, is there actions you guys could take that would maybe help lower one way, or, if there's any investments you would want to make that could have it go up?
I'd say I would say think of expenses as being roughly flat. There's always a little bit of friction as time goes on, merit increases, things of that nature that come through, but I would say roughly flat to slightly up as we go into next year.
Okay,
roughly
great.
Flat from the Q4 numbers.
Yeah,
from the Q4.
Right, from Q4.
From Q2 edition.
Sorry, yeah.
All right, yeah, that's understood. And then, that's all for me. Thank you, guys.
Thank you for your questions. There are no questions waiting at this time, so I will pass the conference back over to Aram Novaco for some additional questions.
Thank you, Sierra. So Scott and Drew, we've got a couple questions for you here that were submitted by our shareholders. The first question is, have you considered rebranding to another name since LendingClub's more than just a lender now?
Great question. So as we talked about, the ways we can serve our members is evolving. As we get to a place where we've got an integrated app that will cover spending and savings in addition to lending. So that's part of the reason why we brought in Mark, who I talked about on the call, to oversee marketing, brand, communications, and bring that deposit expertise. So I don't expect any imminent shifts, but I will say that will be one of the key things on his mind is how we integrate these new offerings into the brand and what evolutions we may need to make.
Okay, great, thank you. And here's a second question. So with the shares trading at such a steep discount to tangible book value, is there a reason the company is not buying back shares?
Yeah, well, I think it's probably worth just a reminder to everyone. We're in the third year of our operating agreement that we entered into as part of the Radius acquisition, and some of the restrictions around that operating agreement make it difficult for us to execute any type of share buyback at this point.
Well, but I will add, however, that the discount that we're seeing is certainly not lost on us, and I don't believe it represents the value that that we will be creating with this business. You know, I'm one of the largest individual shareholders in the company. I've not been selling any shares, and at the recent board meeting, I indicated I post this earnings that I would be considering to purchase in the open market, and wouldn't be surprised if some of the board members did the same.
All right, great. Thank you. So with that, we'll wrap up our third quarter earnings conference call. Thank you for joining us today. And if you have any additional questions, please email us at ir@lendingclub.com. Thank you.
So I'm going to close that out. I don't have a ton of notes to give right now. I'm obviously going to save that for the FinTech Frenzy. However, I don't know if you're allowed to say at the end of your conference call, I'm thinking about buying some shares, and maybe some other people on the board are going to buy some shares as well. That sounds like a little bit of pumping. Why don't you just make your purchases and post them publicly instead of being like, we're thinking about it. We're thinking about it. There's no triggers pulled. Nobody's actually doing anything with their own capital, even though the stock has been low, for months and months and months. But keep in mind, we got some capital and we like this company, and you guys should too. Okay. Then again, I did find it interesting that they said that no buybacks due to restrictions from the recent purchase of their bank license company. So maybe that's also very similar for SoFi. I wouldn't want them to make any buybacks right now, but that regulation probably exists, and that affects SoFi as well. I don't know how long that would be. I'm going to do some research into that now. But let me save some of all my insights for Lending Club on the FinTech Frenzy show tonight at 8:30 p.m. Eastern Standard Time. It's the daily FinTech Frenzy. And if you guys show up early today, you're going to hear some pretty exciting stuff. A little clickbaity. I mean, it's fun for the channel, for the people who actually really like the show. You guys are going to be happy at 8:30 if you show up right on time. If I show up right on time is the real question, though. Supposedly I'm late all the time. Ladies and gentlemen, that's it. Appreciate you guys coming out. Go do something else. Go eat some dinner. I don't know what you guys do at this time. I don't know where you are in the world. Just leave. Go. Be gone. All right. Goodbye.